or just new to our group, welcome to the Opening Playbook. Our mission here is to be a bridge for new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights as timely analysis of what's moving the markets right now, trading education to help you build real skills beyond surface level tips and tricks, and live trade ideas, real-time recommendations you can act on immediately. Opening Playbook is a free daily live webinar. Your hosts of the show are Nathan and Graham. Nathan has over a decade of experience trading Forex, stocks, and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, Overnight Options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is also an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed wrap order option trades for cost-effective entries, as well as created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. He's also a husband, a dad of 2, and the copy chief here at the pub. Now, a lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We'll tell you the hard truth, which is that trading is complex and takes time to learn. But we make the learning process much easier. The Opening Playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We'll dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. Now, it's important to remember that you should never trade with money that you can't afford to lose. Of course, nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please don't trade with money that you can't afford to lose. And let's be ultra clear, any type of trading involves losing some of your trades. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we believe you should always follow. And here are some rules of the road to get you started. Stay calm, try to trade without emotion involved in your decisions, go at your own pace, don't try to keep up with us or other traders, and ask questions freely. We really do want to help in any way that we can. And to help you get started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner I'm posting above. And for answering that quick survey, we'll give you custom content to better help you by using your feedback to improve our classes and education, and give you a free options cheat sheet, a digital, easy to understand options guide that will look something like this. Now, I'd like to give you some tips on using our webinar platform before we get started with our regular program. The button next to number 1 here, we call the hamburger button. That will collapse the green column on the left, and you can leave it collapsed because we don't use it for anything. Number 2 is the pause button. You can pause and resume the presentation whenever you'd like. Number 3 is the mute button. You can mute and unmute the presentation's audio. If you find that you suddenly lose audio during the presentation, make sure you haven't accidentally clicked or tapped on the mute button. Number 4 is the main announcements section, where trades that we take in the current session will be posted, as well as helpful links that can always be found there. Now, this section will only be visible if you're on a large screen. If you're on a mobile device, you won't see announcements here, but we do have another area that you can see them that we'll get to shortly. Number 5 is the toggle for going between light and dark mode, whichever you prefer. Number 6, the monitor icon will enlarge the presentation area without hiding the communications or chat area. Now, this button is shown in 2 places, and I highly recommend using this because it'll give you the best view of the presentation without hiding the chat from you. Number 7 is the picture in a picture button. This will reduce the presentation to a floating window so you can do other work behind it, such as go to your broker platform on a mobile device. Number 8 is the full screen icon. This button will enlarge the presentation to take up the entire screen, covering everything including the chat area. And that's it. So once again, welcome to Opening Playbook. Don't forget to complete that survey to get your free cheat sheet. And now we're going to play our theme song and get to the regular show at the top of the hour.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market
Hey, good morning, folks. How you doing? Welcome to the opening playbook for Tuesday, April 28th. Obviously having some technical issues here. Um, we'll get started in just a minute or two when Nathan gets here. I hope everyone's having a good morning this morning. Sorry about those tech issues. If you're new to opening playbook, we usually play or usually do a little bit of a pre-show, which is what I was trying to do just now, but I was having a lot of trouble with the screen share and all of that. So if you're new to opening playbook, come back tomorrow. Well, stay here now, but also come back tomorrow about 10 minutes early, 15 minutes early, and we go through what the show's about and how to use this platform. And here's Mr. Nathan. Hello, sir.
Hello, how are you?
All right. I was just having some issues. I think my internet is having some issues, so I'm gonna let you run with this. I'm gonna disconnect and reset my router, come back.
No worries. As I always say, internet's not really a big deal in our industry, so
Right.
I wouldn't worry
Right.
too much
And
about
you
it.
never have any problems at Pittsburgh. It's amazing. It's amazing. It's perfect there.
Yeah, it's wonderful. Um, cool. Well, hey everyone. Hope you are doing well. We are. Let me find my. I lost my chat here. Hold on. Let me find my chat for a second. I've got 17,000 windows open. That's an approximation. Um, we are in the heat of earnings season. We've got a lot going on. We've got the market actually moving down for the first time in a little while. Haven't really seen any negative momentum here in a little bit, but it's fairly contained right now, obviously, on the back of that AI news. I think the stock to watch right now is Google. Or actually, it's already moving up a little bit. Google, I think, should be getting some love right now for this negative AI news because the biggest market share taker of that, OpenAI not hitting expectations right now is Google. And so the same thing that's a negative catalyst for these other AI companies should actually be a positive catalyst for Google. So I think that's the one to watch, and we'll keep an eye on it going forward. All right. Today's going to be a little different. I'm actually going to clean up my notes here because we're going to take a little bit of a detour and go down a path of looking at hidden divergence. So this is a technical thing. We don't always get into like a deep technical training here as in like a full-on kind of strategy training, I guess you would call it. Sometimes we do, but right now on this session, we are going to do that. So I just want to clean up my notes here because I missed something I wanted to cover. And then we will dive right in. All right, there we go. How's everyone doing? Give me a quick yes in the chat. Let me know if you are doing well. Hopefully everyone can hear me and see me and all that's coming through. And that was just a Dave internet thing and not a platform or anything else. All right, beautiful, 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 beautiful. Let me quickly cover just where we find ourselves in the market, and then we will jump into hidden divergence. So let's start here. And by the way, earnings really, really picking up now. It's going to be a crazy couple of days here. Hey, John, Kim, Clyde, Andy, Gold, Charles, Marion, Jack, Cynthia, James, Roger, Dave, Bob, Robbie, Mike. Hello, hello, hello. Hey, Keith, hope you guys are doing well. Keith says he'll be doing good when he gets to the golf course. Good for you, Keith. So, yeah, we got a little bit of negativity out there. Q's getting rocked with that AI news. Small caps down quite a bit. Interestingly, the mags, even though some of them got hit a little bit harder, have recovered a little bit better than some of the other, Micron, AMD, etc. And RSP actually below SPY. This is something I pointed out in our morning brief today. Don't be tricked here too much. Yes, tech is down, NASDAQ getting hit pretty hard, pulling everything else down. But actually, it's not just a tech pulling the market. We have some risk off sectors that are getting hit, and tech actually is strong in some other areas. So it's a little bit deceiving here today, the way things are rolling. So utilities popping a little bit, staples and some of the risk off doing well, but we still have financials doing well, and then we have things that are fairly risk off, like industrials and basic materials that are fairly red on the day. So, and by the way, technology and discretionary was up from the opening bell. I'm not sure if they've settled back down a little bit, more break even, I think, because I haven't looked, jumping from the members meeting right to here. But they actually started showing a little bit of recovery strength out of the gate, which means there's still some kind of holding the serve, so to speak, on the risk on sectors. Energy taking a pop, metals getting flushed as they tend to be just not having any staying power right now. We'll keep an eye on gold and silver, maybe do a little bit of a separate lesson on that in the near future, because I do think there are some opportunities in gold and silver worth watching. But right now, we're actually getting a very interesting mix. You would think with everything being so bullish and the AI news coming, you'd essentially see technology as a big red bubble here and pretty much everything else green. But we're seeing more of a mix of that. You can see it as well if we go over here to the heat map, where we have still 57% green, 43% red. This is a little bit delayed, but gives you the idea. Coke off earnings up about 5%. Some technology mixed in here, some software mixed in here. By the way, software might make a run here. Let's look at that really quickly. I don't want to get too off the beaten path here, but just to show you here.
I'm back, by the way.
Okay, so just one example. This is XSW, which is one of the State Street software. It's been getting absolutely torn apart, leading the flush down and been down in general all the way back going to October of 2025. Totally front ran the move down. Meanwhile, on the flip side of the coin, you have semiconductors doing this. So you have semiconductors on the back of an AI rip doing this. You have software doing something more like this. The divergence between two things that we would both consider tech is about as dramatic as we've ever seen. I personally believe, this is my big bold prediction, that software is going to actually make a big rally up before it gets its AI death nail. Because I think the AI death nail is coming, where your kind of corporate level software just doesn't make sense when you can build it yourself with a click of the button. What I think has happened is that they kind of front ran that expectation a little too heavily. Right now, I think people are finding out that they put a couple years into AI, they put a couple $100 million into AI, and actually it doesn't have the robustness to do some of the true software based actions and kind of consistency that you need at scale. And so I think they're kind of backing off that a little bit, and you'll see software come back in. That's why that trade, like on something like HubSpot, I don't think that's a 5-year trade, because I think HubSpot might not exist in 5 years, but I think it might be a 1-year trade. And I'll be very interested to see if software can make a rally here in recovery based on just the oversold, overexcitement that AI is going to replace every piece of software that's ever existed on the planet Earth, and then just a not so fast moment here before AI actually develops. That's very common with technology, by the way. You get a wave of overexcitement and over expectation. You get a second wave of, oh shoot, we kind of over expected, over anticipated, and then you get usually a third wave of, yeah, technology does move forward and take over at the expectation. So that's kind of what I think is going to happen on software. That's my big bold prediction, that we're actually going to get a shocking, surprising rally on software that catches everyone off guard. The old boring companies that people said were dead in the water, your DocuSigns and your HubSpots, et cetera. And then they will have to pay the ultimate price, in my opinion, because yes, AI will catch up at some point. And if you are a company that relies on something that sends emails or keeps records or does basic automations, yes, at some point you will have AI that can do that at the robustness that you need, even at the mega cap level. So sorry for that detour, but I think that is something to keep an eye on. So you're seeing some of those smaller companies pop back up, not smaller, but old school, I should say. And then you have a whole mix of things down here at the bottom, but obviously very concentrated around chips and the AI picks and shovels companies: AMD, Oracle, Clack, Broadcom, ANET, AMAT, ARM, TSM, Micron, NVIDIA, all of them just loaded here at the bottom and pulling the market down right now. So that's your heat map. Let's go ahead and jump in to our lesson for the day. Like I said, maybe a little bit different. Talking about this idea of what is hidden divergence and how to find it. Give me a quick yes in the chat if you have heard of hidden divergence before. Just give me a quick yes, and give me a something else if you've heard of regular divergence, but maybe not hidden divergence. Okay, looks like we got maybe a 50-50 mix or so. To me, there's only a few kind of old school technical things that I would present as this is worth knowing. And this is one of them. And actually, if you go look at the research, divergence in general, but specifically hidden divergence, has really, really good kind of data proof behind it, empirical proof behind it. It's not as simple as, yeah, it works, so go trade it all the time, because you get into the nuance of how to trade it and how to build a system around it and all of that. But I actually think it is worth knowing, which is why we're going to spend 30 minutes or so here and go through what it is and how it works. I'm just going to give you a pretty basic overview as much as I can in 30 minutes or so. And obviously we can dive deeper in another session if you guys are interested, or maybe kind of build a strategy around it. Maybe that would be fun to, build an opening playbook strategy around divergence. But again, the reason I'm going off the beaten path and teaching you something that's not like a Nate strategy, it's just more of a general strategy, is because I think it is one of the few technical things worth actually knowing. The old school, the moving average crossovers and the Bollinger Bands and all the things that I don't put a lot of weight into. This is one that I think is worth knowing. So let's go ahead and jump right in. Use the chat if you have questions along the way. And hopefully this will just give you a quick tool in the toolbox to use going forward. So I hate that Google slide thing that now shrinks my slides half the time when I'm going through it. But today we're going to talk about hidden divergence. So most traders have heard the term divergence in some way or another, but I would imagine not many really understand what it is, how it works, or specifically how the hidden divergence element of it works. So let's just start with the basics. What does divergence even mean as a term? Well, essentially, it's when two things that usually move together all of a sudden disagree. So you can think about your car for a second, okay? Man, this slide thing is so annoying. When you hit the gas pedal in your vehicle, the RPM tick, flips up. The gauge of the RPMs goes up when you slam that gas pedal down. And what you also do is you hear and feel the engine getting louder too. Everything kind of aligns in that moment, right? I had a Jaguar F-Type R with 550 horsepower, and when I hit that gas pedal and the RPMs went up, I didn't just need the gauge to say, wait, hold on, is the engine going up? I could feel it. I could hear it. That engine, and your whole body kind of vibrates with that engine, and those things aligned. So we know that RPM and the engine moving go together. But imagine if I hit the gas pedal and I saw the tachometer flip up, to 7,000 RPMs, but the engine didn't feel or sound any different. It just sounded the same. Well, I would think, okay, something is off here, right? I hit the gas pedal, the RPMs spiked up, but what usually aligns with that is that the engine gets a lot louder and I can feel it in my bones. And now that's not happening. So something seems to be wrong. And of course, you'd be right. Something is wrong, right? Something changed on the hood, even though the gauge has not figured that out yet, right? The gauge is still saying, hey, we're at 7,000 RPMs, but we kind of know we're not at 7,000 RPMs, or else I would feel it in the engine. And that's what I would kind of consider divergence, where two things that normally go together, that we know make sense, that are correlated together, don't line up. And so something is off. Something is telling us that there is a mismatch in the reality of what we're seeing or feeling. In this case, what we're seeing on the chart. And so in trading, we have that exact same idea. We're comparing two things that usually move together, and what we're looking for is the moment they break apart from one another. And there are actually a lot of different versions of divergence in the market. Now, most of them are connected to price. Not all. You could have MACD versus RSI and some other ones, but usually they're connected to price. So you could have, volume versus price. You could have momentum versus price, order flow versus price, et cetera. Actually, one of the most powerful versions of divergence is what they call it? Cumulative volume divergence. I think CVD. I think is the term where you actually have the level 2 data of order flow and momentum, and you compare that, because now you can do a true mathematical calculation. You can say, hold on, the market cap of Apple is 2.8 trillion. There were 132 billion orders to the upside. There were 92 billion orders to the downside. The net difference is this against the market cap. That should move the share price up 80 cents, but the share price is only up 40 cents, and therefore we have divergence. So that's like an extremely deep technical version of divergence, where you're actually mapping out what should happen in price versus what is actually happening in price. We're going to go a little simpler than that today. So one of the easiest ones to look for with any basic charting platform is momentum and price in the form of the RSI versus underlying price. Now, remember, momentum is always trying to measure how much force is contained inside a move. So it's not actually measuring price, even though it often feels like it is. That's not what it's attempting to measure. So, of course, it is extremely correlated to price itself. For example, we wouldn't say, hey, the bullish momentum is high today, but the stock is down 2%. No one would ever say that, because by definition, they are heavily correlated and connected to one another. If we're saying bullish momentum is really high today, we are almost always exclusively looking at a chart that's going up. I would imagine most of us have never heard someone say, yeah, bullish momentum is just crushing today and the stock is falling off a cliff, because by definition, they're connected to each other. But a more subtle version of divergence exists, and that's when a stock keeps going up while the strength behind that move is fading. And so again, one simple way to measure this is called RSI. RSI stands for Relative Strength Index. It's essentially a basic momentum indicator. All it's really measuring is a percentage calculation between 0 and 100. So if you go on your chart, you put on RSI, you're going to see a range that looks something like the one I have right now on my screen, 0 to 100. And then most RSIs default to 30 and 70 as the quote-unquote levels. 70 overbought, 30 oversold, some 20-80, some actually skew it to the bullish side and do 20-70. Lots of different ways you can use RSI, but what you need to know for now is that it's measuring momentum in one direction or the other, and we're just going to talk about the basic levels that are pretty much default for most RSI indicators. Above 70, bullish momentum; below 30, oversold, bearish momentum. And that's pretty much all you need to know about RSI for now. We could have a whole lesson on it, but that's really all you need to know for right now. Now, most charting platforms have it built in for free. In fact, every charting platform I've ever seen has it built in for free. TradingView, Thinkorswim, whatever else. And most platforms default to a 14-period setting which is just fine for our purposes. That's just measuring the last 14 candles on whatever time frame you happen to be on. All right, so now we have two things. We have price and we have RSI. So let me show you the kind of divergence everyone would teach first, and then I'll show you why it's not, in my opinion, the one that you really want. Now, regular divergence is fine, to be clear, but I don't think it's the one that gives you the best, how shall we say, bang for the buck in terms of actually trading it actionably. So regular divergence is when price makes a new high, but RSI does not. Okay, let me pause here for a second, just make sure that you guys are seeing this clearly enough, because if it's not clear to your eyeballs, then nothing else I say today is going to make a ton of sense, which is that on this chart, we have price, that's at the top. We have RSI, that's our relative strength indicator here at the bottom. Okay, and what we see is that price goes from a lower level to a higher level. We call these pivots. I'll talk about those in a second, but it makes a low here, a higher low here, a higher low down here. So it is pivoting higher. And at the same time, this RSI indicator is making structure lower, where the high over here is higher than this one. So structurally speaking, RSI is moving down, while structurally speaking, price is moving higher. And therefore, they disagree between the two structures. Does that make sense? Can everyone see that with their eyes? Higher structure, lower structure overlapping at the same time. If you can't see it, that's okay. We can pause here for a moment, because you got it. This structure piece has to really make sense to you, or the rest of today's class won't make a whole lot of sense. So if the answer is no, that's fine. We can we can pause for a second, but sounds like we're good to go. Okay, positive structure, negative structure, that would be considered divergence. And yes, it would absolutely work the other way around. Lower structure on price, but higher structure on the RSI would be bullish divergence. So again, the idea very simple here. Price is making new highs, but momentum is fading. So the move is about to reverse. And by the way, this was a beautiful one. Would have called that reversal just right. Okay, so now there is a problem here with what we would consider regular divergence. Basically, what it's trying to do is call a top, or it's trying to call a bottom. And calling tops and bottoms is essentially one of the hardest things that you can do as a trader. There's nothing wrong with the strategy. Again, divergence is a proven strong signal. But the issue is it takes massive discipline and the willingness to shake off loser after loser in a big trend to finally capture your winner. Because a stock in a strong uptrend can print regular divergence 3 or 4 or 5 times in a row and just kind of keep ripping higher, because the trend itself is very, very strong. And so if you're trading regular divergence, each one of those is going to be a losing trade for someone who thought this is the top. So we're going to set regular divergence aside for a moment. Now, again, there's nothing wrong with it, okay? Just to be clear, if you get a stock that's moving like this, eventually you'll have a deep correction, eventually. The issue is it might print divergence here and somewhere here and here and then here again and here and here. So you might have 7 trades that are wrong, and then eventually it'll probably print a beautiful divergence right at the top, and you'll have a big money trade here. Most of us are not disciplined enough and aren't good enough at trading those super high positive risk reward strategies that we could shake off 8 losers in a row and then hit our winner and be okay with it. Okay, so that kind of in and of itself is why regular divergence is really hard. It's not a bad strategy. Empirically, the evidence for it is actually quite good. It's just difficult to execute as a trader. Now, there is a different kind of divergence that flips that entire idea on its head, and that's called hidden divergence. Okay. Now, here is why hidden divergence is actually different. Regular divergence happens at the end of a trend. It's basically looking for a reversal signal, but hidden divergence happens during a trend. It's essentially a continuation signal that happens during momentum in either direction. So instead of trying to call the top, what hidden divergence does is it helps you ride the existing move, which, as you know, I'm a big fan of. I'm not a big fan of trying to capture exact reversals. I am a big fan of riding existing moves. So let me go ahead and show you what hidden divergence would look like. Imagine a stock that's already in a great trend. Like any trend, it's not going to go straight up, right? It's going to have pullbacks along the way. And when a pullback is contained and makes a higher high, while momentum quietly moves lower, we have what we would call hidden divergence. Okay, so in this situation, what we have is a good uptrend that was already moving. We have a big move up, a continuation. This is a low here or a pivot. This is a low here or a pivot. And between these two lows, we have the market going higher. At the exact same time, this is our RSI down here. Between this pivot and this pivot, the RSI has bearish structure while the price itself has bullish structure. Low here, higher low here, low here, lower low here. Everyone see it? Quick yes in the chat. Let me know if you see it. And the reason that this is different is because price is on the positive side versus momentum is on the negative side, which is exactly the opposite of what most people would consider divergence. They would look for price to be kind of, the laggard, and they would look for momentum to be sneakily moving ahead. We're doing the opposite. We're saying actually price is kind of moving ahead while momentum is lagging behind. That is what we would consider hidden divergence. Price, higher low, RSI, lower low, that is bullish divergence. Okay, just to be clear, price higher low, RSI lower low, bullish divergence. Price lower high, RSI higher high, bearish divergence. All right, those are our definitions. That's it. That's the whole entire rule. The entire definition right there. You just got it. So the question is, why should I care that the indicator did one thing while price did something entirely different? Well, let me explain why this works. It's actually pretty fascinating. And it is, like I said, one of the rare kind of technical signals that is empirically reliable over time. So when price makes a higher low, but RSI dips deeper than the last time, what it means is that the pullback itself is hitting momentum harder than it is hitting price, right? So momentum, as in the indicator, is getting hit harder than price. We know that empirically because price moved slightly higher between the two levels, but momentum moved lower between the two levels. Now, at first, you would think that seems bearish, right? Like momentum is actually going down while price goes higher, so it's not a strong move. How many of you, when you first see that definition, think, wait a minute, that sounds actually bearish, right? Because what it's saying is price is slowly moving a little bit higher, but underneath the surface, momentum is moving down. And so actually that's a bearish signal showing us that price is probably going to reverse and go down, because even though it looks like price is going higher, momentum is going lower. Therefore, this should be a bearish signal, right? How many of you think when you first see that sounds like a bearish signal? We got this sneaky momentum moving lower while price is moving higher. Well, when you think of it in terms of the actual mechanics of the market, it's very bullish. Because remember, the RSI is simply measuring 14 periods and determining a momentum level. That's all RSI is doing. It's saying, hey, give me the last 14. Let's measure it. So usually that aligns perfectly with ebbs and flows of price action itself, because RSI makes highs when price does, and RSI makes lows when price does. They ebb and flow. Why? Well, because it's literally measuring what price is doing. And so, of course, it's going to be heavily correlated with price itself. All it's really doing is slightly lagging behind to quantify the momentum, right? Because that's all RSI is. It's a lagging indicator that's quantifying the momentum within those moves, particularly within those 14 periods. So when it lags significantly behind, enough that it's outright moving lower while price is outright moving higher, it means something abnormal is happening. It just and I do mean abnormal as in the basic definition, because it doesn't happen very often. So objectively, something abnormal has happened. And that abnormality is that buyers or sellers in the opposite scenario are stepping in early to a move. Because what's happening is that price is beginning to turn even before the indicator has a chance to quantify it, which can really only happen with institutional level buying. Okay, so again, let's just think about this at the actual mechanics of the market. All RSI is doing is it's taking, one candle, then the next candle, then the next candle, the next one, and it's quantifying these candle moves over the last 14 days, putting a score on them, quantifying them. And so for the most part, it's going to just follow along because it's quantifying the actual candles with the price. But what happens when we get this hidden divergence is these candles start moving down, but buyers step in and actually push the price up, and it starts to make a bullish structure out of what looked like it was going to be a pullback. But because the RSI is capturing these last 14 days, it still has to average those out from the recent flow of bearish candles, and it's actually making a lower low. So it has a low point here and a low point here because it's lagging behind while the price itself is moving. Now, this happens rarely because it's calculating the candles themselves. But what it means is that price actually flipped around and got going higher even before the averages could be calculated by the lagging indicator. And that can really only happen when there's enough institutional buying to flip this around ahead of schedule. So that's really what I like to think of. If you want to kind of write down a definition of what hidden divergence actually is, essentially what it is to me is it's institutional money flipping things around ahead of schedule. And so that's why it's a bearish indicator, even though you would think because it's anti-momentum, it would be a bearish indicator. It's actually very bullish. It's institutional money, high order flow, flipping things around ahead of schedule. And that only makes sense in the context of a trend, and it only makes sense in the context of price action itself getting ahead of the indicator. So here's the 4-step process for doing this. It's really simple. If you want to write these down or just check out the slideshow in the VIP area afterwards, really simple. Number one, you want to identify a trend. Well, what is a trend? It's pretty basic. You can only find hidden divergence inside an existing trend. No trend, no hidden divergence, skip the chart, move on. If you're in a sideways market, you'll see a lot more hidden divergence. It just won't mean anything. Why will you see it? Well, because the highs and lows don't mean anything. They're not, there's no real structure there. So the divergence isn't diverging off anything. So you don't actually have anything worth looking at unless you have a trend to begin with. Now, again, what is a trend? Well, a trend is just a series of higher highs and higher lows, or lower highs, and lower lows. That's it. So we define the trend on price, not on RSI or anything else. So before anything else matters, you have to know that you have a trend in the truest sense of the word, which is higher highs, higher lows, or lower highs and lower lows of price itself. Step 2, you have to actually know what swing points you're measuring. Okay? Because remember, we don't just need the chart to kind of look like maybe one's going the other direction, one's going opposite. We actually have to say, where are the lower lows, where are the lower highs, and vice versa. Well, to do that, all we have to do is look at the prices, or in this case, you can just draw it on the chart with a trend, the pivot points within the trend itself. To do that, definitionally, is a swing low has higher lows on both sides, right? So it looks like a V, and a swing high is the opposite, right? It looks like, a pivot, like a upside down V. What's that? What do they call those? What do they call those upside? A trivet or something? There's a name for that.
It's called a carrot.
A carrot. There you go. Yeah, a carrot. So a swing high looks like this, and a swing low looks like this. All you're doing is looking for a candle where the lowest point of that candle is lower than the ones on the side of it, or a candle where the highest point of that candle is higher than the ones beside it. You can see them right here. Sometimes they're very subtle. Sometimes they're very obvious, right? Like this one's a little more obvious. This one's quite obvious. This one's quite obvious. You can kind of see the V shape, right? You have to have those, or else you can't actually measure from highs to lows or lows to highs because they're not identified in the first place. By the way, Thinkorswim, every other platform will have ways to do that too. Pivot points or swing high, swing low markers, or whatever. You can do it fairly easily with your eyes if you zoom into a candlestick chart, but every platform will also have some basic indicators that will quantify those for you as well. Okay? So what you're looking at is you're looking at the two most recent swing points. I mean, if you're back testing, maybe you're looking for further back. But if you're trying to trade in real time, you got to look at the recent ones. So most recent swing high and swing low, or vice versa. Yes, the wicks count, Tom. So the wicks would count for finding a pivot point. So for bullish hidden divergence, we're looking at the two most recent swing lows in the uptrend, right? So bullish looks like this. We're grabbing this one and this one. And the bearish, just the opposite, looks like this. We're grabbing the high and the high. Lower highs for bearish, higher lows for bullish. Honestly, it sounds almost complicated when you put it in textual definition, but when you look at visually on a chart, just think about you're measuring the bottom of the uptrend or you're measuring the top of the downtrend. It's pretty obvious visually once you actually look at it. Okay, now we have to actually compare price to RSI at those 2 points, right? So we know our 2 points. We just draw it. Okay, 164 to 170. There's our most recent swing lows on this uptrend. Okay, so we know that just by looking at the chart. We can measure it just by looking at the chart. And now we're just going to compare. Did RSI make a lower low between those two or at the same time? Okay, so we measure this. And then we're going to look down at the RSI and say, okay, well, did it actually go lower? If it was going lower and it made a lower low, well, then we've just found bullish hidden divergence within that context, because we know we have a trend, we know price made higher lows, and now we say RSI made lower lows at the same time. One final step, just make sure it's actually meaningful. Okay, not all divergence is worth trading. A tiny difference between the two RSIs, that's not real divergence. That would just be noise. Like, oh, hey, it was at 70 and then it was at 70.02 while price moved higher. Okay, that's not divergence. Here's the rule of thumb: if you have to squint to see it, probably doesn't count, right? If you're like, wait, maybe it was over by 0.02%, probably doesn't count. Now, the price difference and RSI difference need to be obvious. Not exact, but just obvious enough that you can kind of see it. And folks, that's the entire thing. That's the entire idea around this hidden divergence, that you have a clear trend, an obvious trend. Price front runs what we see in momentum, and you kind of see an early flip. Now, to me, the most obvious way to look at that is just to draw it with two lines. So you put the RSI in your chart, and you put obviously price, which hopefully price is already on your chart, or you're looking at some really weird charts. But you have price on your chart, you have RSI on your chart. Just draw two lines. If one trend line is up and one trend line is down, now you have divergence, and the swing lows and swing highs are really obvious to see. Let me see if I can pull up a chart here.
I feel like you just challenged me to trade only without seeing price, like just trade with all the other studies on the screen, but no price.
I feel like a lot of people are pretty much there. They have so many things covering the candles that you can't really see them.
Right. It goes back to like the chicken picking the trade or something. It's pretty much.
Yeah. Yep. So people asked what time frame to do this on. For intraday, or even, I shouldn't even say intraday, but for like timing trades, I really like hourly charts. If you're looking for something that is more exact, more timing, I really like hourly charts. If you're talking about something that is long-term, then something like a daily chart is going to be your best bet. Okay, but here I just have basic RSI on my chart, and what you'll notice is you look at the RSI, the pivots on the RSI are really easy to see, right? Because they literally look like V's. They literally look like points. So you can see them pretty easily. And so if you just picked any random point, we don't know if this is going to be a good swing low because this candle is still live, but we can look at this one. Well, that one actually is terrible because it's the exact same price. Okay, let's look at this one. Okay, we had a series of higher lows from, this is April 16th to a little bit later on April 17th. And then at the same time, we have the RSI, which is essentially mirroring that move. The low might be a tiny bit higher there, but what do we notice about these two lines? Well, they're both moving in the same direction, right? They're both slanted in the same direction. Therefore, there's no divergence. We get a little bit of an overreaction and a lag delay from this gap, but not actually true divergence because we haven't seen other lows mirror that. Okay. Same thing here. Okay. A low here, a higher low here. We go down, we find the low here, and we find another low. I guess technically would be about right there where that pivots. They're moving in the same direction. When you get one that's moving in the opposite direction, then you have divergence. Now, actually, on most RSI indicators, you can even have it find it for you. You can just click divergence, and if you find it, hey, look, that'll find some for you. Now, I just accidentally moved that into the fold somehow by clicking a button that I'm not sure what I clicked.
Just zoomed out too much?
I think I moved it.
Oh, I still see it on there.
I think I moved it from being in the pane below to like on the main pane of the chart somehow on accident. Okay, so here, this is very obvious, right? This line starts here. Probably calling this candle or that candle the pivot. I'm not sure which one, but either way, very obviously moving down, and this line is moving up. Well, that's bullish divergence, right? You have price very clearly making a lower low, RSI very clearly making a higher high, starting from the same point. And what do you know? It's actually a really good divergence signal. If you bought there, you would have made some money. It's just a basic RSI indicator set to period 14, and it works for any time frame. Now, I'm not a big fan of using it on like 1 minute time frames or 5 minute time frames, but generally speaking, any trend that you're willing to trade, which you would probably want to see on the daily 4 hour, 1 hour chart at least, you can then apply RSI. Now, the hidden divergence can be a little bit trickier because we actually want to look for the opportunities where price is front running. Regular divergence can work if you do it in line with the trend. I like it much better, but hidden divergence, like we talked about today, is a much stronger signal. Here is an example of regular divergence really failing pretty bad. Here's an example of regular divergence failing pretty bad. Here's an example of regular divergence, maybe being okay, but not looking great. And that's because you're going to get a lot of lagging divergence on stocks that are making real reversals. And you don't want to trade into the teeth of a new trend that's forming that's going the other direction. Whereas when you have price that's actually doing the confirmation itself, you have a much higher degree of success. I ran the numbers on this a while ago. I can't give them to you off the top of my head, but they're significantly more positive on hidden divergence than regular divergence as long as you're trend trading, because you're letting price be the filter itself. You're basically saying, listen, I'm only trading it to the upside when price itself has already confirmed the move, versus trying to use kind of this lagging indicator that maybe is giving me a calculation that price is too far down when it should be, starting to turn around. That can work. There's good empirical evidence for it, but it's not nearly as good, in my opinion, as letting price dictate that move itself. So that's why I really like the hidden divergence methodology a lot better. It's not something that I have a whole bunch of strategies built around or anything like that, but I do think it's a kind of a worth knowing technical understanding of the markets versus, like I said, most other things that we would talk about on the technical side. I would say, not really worth putting in the tool belt and trying to apply. All right. Eric asked, why RSI? I don't have a great answer, Eric, on RSI, other than when I did some studies on this a little while ago, price and RSI seem to be the most consistent on the combinations. I know some people really like other styles. Some people like RSI, MACD, and price in kind of a triumvirate combination. There's lots of other ways to do it. Actually, the most successful way to do divergence is using a cumulative volume approach with level 2 data, but that gets pretty nuanced and in the weeds. I think RSI and price is simple enough and easy enough that anyone can do it on a chart, and it lets price lead the way, which I'm a big fan of. Rick, that the divergence I was just showing you was TradingView's default relative strength with regular divergence, not hidden divergence. So, Rick, that was just TradingView default and then clicking calculate divergence, but that's going to give you regular. That's the one that I don't really like. But I was just giving you some examples of what regular divergence would look like. As far as timeframes, one of the beautiful things about divergence is it really is applicable on any time frame. Now, like I said, I wouldn't be trading it on a 1-minute chart. Some people do. I certainly wouldn't. I would look for trades that or trends, I should say, that you would want to trade on a daily chart or a 4-hour chart, and then look for more exacting entries. To me, that's the most applicable way to use it.
Would you mind going back to the first chart where you drew the lines to show regular divergence?
Yes, sir. You want the hidden one or the regular one? You said regular.
The regular one. The regular one. While you were defining regular divergence. So look, my question is, what makes that not hidden divergence? Because one's going up, the other one's going down, like the one that you showed hidden divergence on. So
regular divergence, we would say, is when price is the one lagging. We're using in regular divergence, you're always using the indicator to predict the move. So the indicator is going down, and therefore you're saying, even though price is going up, I'm predicting a down move.
Okay, but before that down move becomes visible, like at the peak, how do you know the difference?
Because
is it in a downtrend or an uptrend?
It doesn't matter. If you're using the indicator as your predictor, you're trading regular divergence. If you're using price as your predictor, and when I say predictor, as your direction,
right? Okay, but they can't both be right. In other words, if the indication looks the same,
it doesn't look the same. It doesn't look the same in the context of the trend. I see what you're saying. So you're saying here price is also going up, and RSI is also going down. Right. Is also going down.
Right.
So two differences. One, again, price lead versus RSI lead. But the other one, which is important, is that you're actually measuring the highs on regular divergence versus the lows. And in hidden divergence, you're actually measuring the same lows versus lows.
Gotcha.
So, but the important thing for me is not really that. The important thing for me is I want price to lead and I want to trade in trend. So I want to look for early continuation, not early signs of a reversal. That's really ultimately why I make the distinction, not because of the slight technical differences. If you looked at it and you were looking for a reversal, then you would say, well, this all looks the same. But the difference is in a regular divergence, you'd be wanting to trade it up here at a high, not at a low. You see what I'm saying?
So I guess what I was trying to figure out and get at this point is the difference isn't in the chart. It's in your analysis. It's in your interpretation of the chart.
Right. But the chart is different too, because again, regular divergence is going to fire at a high, whereas the hidden divergence is actually going to fire at the low. You see what I'm saying? It's going to say, okay, we got a lower low. It started moving up. Hidden divergence fires here. That's really thick writing. Hidden divergence fires here, where regular divergence is actually going to fire all the way up here. So they're firing at different places because one, by its very nature, it's a true reversal signal, and one is a very real continuation signal. But the line's moving the different direction at the same time. Yes, is actually equivalent.
Yeah. Gotcha.
And in this case, even more equivalent because price is going up and RSI is going down. So that part is true. The difference I would say is we're measuring lows and highs here to try to find a top that's reversing in regular divergence versus lows versus lows, which is trying to find.
I guess it would be confusing. Continuing. I guess it would be confusing if that same RSI chart had lower lows.
Right.
Then it would be kind of mixed signals.
Well, and two, if this was a longer form of a trend that was going down, and this was just a pullback within that trend.
Yeah. Okay.
So there's definitely some nuance there. The easy way for me to think about it is I want price to be my leading indicator, and I want to trade it essentially at a higher low continuation, never a higher high reversal.
Gotcha.
And Harry said you have to wait for a pivot point. Yes, it has to have a real pivot point here. So, for example, this one, you might say, wait, hold on. There's no pivot point here. We only got one candle. Well, true. That's not the pivot, but there was a pivot here. The trend line doesn't catch it quite right, but we don't care about that technically. That's a pivot, and therefore there is a higher high here at the same time that there is a lower low here, and that's why it finds divergence. So yes, you do need an actual pivot in price.
Cool.
Soup says down a new Kia today. I've lost a lot of Kias this year. Soup. I think I maybe
you could
lost
actually fit a couple
Mercedes.
Kias in your van.
Yeah, I might have lost a couple Mercedes along the way too, but thankfully we've made a couple Mercedes, so that's that's the wash, I guess.
As long as you didn't lose any of the kids.
Guys, if anyone took the UPS trade, which I didn't even post in the chat yesterday because volume was low, but if you took it, we got a nice little recovery after the outside move. I'm going to put a target on mine here for about 89 cents. Be about a 90% gain if I can get filled here on UPS. I did the 50. I did 50 cents on the 108 puts. If anyone ventured out to take a UPS earnings trade.
I don't think they had a choice. I don't think anybody could get in those trades yesterday.
Well, it was interesting. We were saying the volume looked low, and then I threw that UPS order out at 50 cents. It filled in a millisecond at 50 cents, which was at the low end of the mid price. So I don't know. Sometimes the volume can be a little bit deceiving just depending on what the market makers are doing. And like sometimes they'll play ball with you a lot more. That might be because they need to hedge some orders. So they're not, the volume is not there in the contract, but they're actually still happy to take the volume because they want to hedge some other things. So it can be a little bit deceiving. That's one of the reasons I don't care about volume and open interest at nearly as much as everyone else makes out to be a big deal. Because if I can get the price I want, then I'm going to feel pretty good. Now, yes, I do then have to deal with maybe I'm not going to get out of this trade like I want to. And, that can be a risk that you don't want to take under certain circumstances. But, with most spreads and things like that, you always have the I can exercise a bailout. And, you know what I mean? So there's like a lot of reasons why I think the only trade high open interest is a little bit too generalized of a rule that doesn't actually apply very well. So anyway, that's a rabbit trail we weren't supposed to go on today, but just, you know, just one of those things that I think people can kind of get wrong or at least overstate, I guess I would say. That doesn't necessarily apply. So anyway, I think I answered that chat.
Yeah. Do you open and close your spread trades in unison?
Always, yes. Cool.
All right.
All right. Well, Dave, do we
I've
have?
got the Inca machine on deck.
Do we?
I do.
Well, that's lovely because I have an income machine class today.
Yep.
All right. Well, hey guys, trade with the income machine.
It's at a very low price today.
Yeah, it is. It is.
If you guys want an opportunity to get the Inca machine for free for 30 days, watch this presentation and you can use it for free, no catch. Get multiple trades a day. Choose whether you want to go conservative, balanced, or aggressive on each trade. Gives you all the options and everything you need to do. And gives you a bunch of trades each day. Pretty cool. Use it for free. Watch this.
So today you guys are going to see the first income tool of its kind. It's designed to give you different choices, different options, all done for you. And that way you can find the one that you find most appealing. And today, by the end of the class, you can unlock the newest income opportunity today. No payment necessary, nothing like that. Like Nate said, no strings attached. Now, the trades expressed today are based on signals that the income machine generated with the benefit of hindsight. And while today's guest, Nate, has been using this tool with great success in his own trades, including a 93.3% win rate as of this last week, with a 4.92 profit factor on live signals. Well, you guys know that that's great, but there's going to be winners, there's going to be losers, so let's be smart here. Now, every example today is based on $2,500, unless